Howdy and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald and it is Nvidia Day, my friends. The markets are in a holding pattern as I record this with all eyes on Nvidia after the bell. Now that makes tremendous sense to me and it's right on schedule. I wouldn't expect anything less. So let's cut right to the chase. Here's my playbook. There's a lot of news out there that I think is interesting. Number one, first and foremost, all eyes are on Nvidia. Now, as I've talked about this week, am expecting 50 to 60% growth top line, probably about 20% bottom line. But as I noted yesterday during a conversation with the super savvy Stuart Varney, the numbers will be nowhere near as important as the narrative. Here's the thing about that. Wall Street is going to fall all over any explanation related to tariffs. But what you actually want to watch as an investor is what I call the footnote language, meaning the stuff that's actually buried in management's remarks, because that's where you're going to see the forward-looking stuff. Now, meanwhile, I've suggested several straddles recently, an options bet that allows you to play both sides of a big move. Now, I'm getting asked if I see that strategy working again this time around. Nope. The volatility simply isn't there. Now, prices have been basically flat for the past 5 days, which suggests that nobody is willing to stick out his or her neck, so there's no definable edge that I can identify. Sometimes that happens, and when it does, you simply move on to the next opportunity. Now, number two today, U.S. tech is holding its ground, but global tech not so much. This catches my attention, and I wanted to bring it to yours. There's a common misconception that all stocks and markets are subject to the same risks, and it is not true. For example, headlines today, in case in point, suggest that ASML, and I have to really get this name right, ASML has lost over $130 billion in market value in under a year. Now, just like that, the chip sector got dragged back into the whole tariffs and Chinese crossfire thing. Shares of the Dutch lithography giant have dropped from over 1,000 euros last July to under 680 this week, and that is a brutal takedown. That has wiped nearly a third off its valuation, some 120 euros or roughly $130 in all per share. Now, the narrative, of course, is simple. U.S. export restrictions to China, political noise around tariffs, rising questions about AI demand have spooked the market, blah, 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 blah. The reality is that ASML can't sell its most advanced EUV machines to China right now. And the CEO says that particular slice of business will only shrink further in 2025. Now, here's the thing about this and where you want to focus. This isn't a new story. The geopolitical risk was always there. And while headlines scream opportunity, the reality is more complicated. ASML may have a monopoly on high-end chip tools, but it is still a European firm exposed to the whims of global policy, restrictive EU regs, and a customer base that includes the very buyers now facing uncertainty. Wall Street, of course, is still largely bullish. Analysts are calling for roughly 17% upside, but names like Wells Fargo say management remains confident in 2025-26 growth. I'm not sure it makes sense to take the bait. Now, an investing tip to think about in a situation like this one. Painting every stock with the same brush in any industry is a bad move that tends to cost unsuspecting investor a lot of money over time. There is always a best to buy and a rest to ignore. And again, it doesn't matter what industry you're talking about. So buy the best, ignore the rest. It's going to serve you well over time. Number three today, can Filosa get the job done? Stellantis, the car maker, just handed the keys to North American COO Antonio Filosa, who will step in as CEO on 23 June following Carlos Tavares' unexpected December exit. Now, Filosa inherits a dashboard full of warning lights. Can't stop at the puns this morning. Profits are down, U.S. sales are sputtering, and looming trade tariffs could throw a wrench into what's already a messy ride. Things were so bad, remember, that the company pulled its 2025 guidance altogether after Q1 net revenue fell 14% and the stock has lost nearly 30% year to date. I don't know about you, but that is not exactly the handoff you would dream of, or at least I would. Now, should you buy it? It's a popular stock. A lot of people like it, but here's how I come down on it. I like the fact that Filosa is a 25-year industry vet and a former Jeep CEO because it suggests he gets what's happening. Now, he's also designated U.S. markets as a priority, so that's a plus too. Even so, and that said, I'll likely pass because Stellantis reported a 70% collapse in net profit and a 17% revenue drop in 24. That's because really, that strikes me as less of a soft landing and more of a structural failure. Now, to be fair, and here's where it gets fun, is we are talking about a $10 stock. So I can make the case for buying a few speculative shares, putting them on a shelf for the next decade, and seeing if it's an interesting gambit, especially if you can bag a free trade or two along the way. If you're not familiar with that, that's a favorite OBA investing tactic that helps you maximize profit potential while also minimizing risk along the way. So big in my book. There's an investing tip that goes here really too, because what you're talking about is turnaround. Turnarounds are always tempting. But buying junk and hoping for genius is a tough way to grow wealth. So log that one away. Number 4, could this finally put Toyota back on the map? Now, Toyota could have completely dominated the hybrid EV industry had it widely dispersed Prius hybrid technology through its entire lineup back in the day, or at least that's what I think. Instead, the company is now playing catch-up, having been resoundingly thrashed by global competitors from Korea, from China, from all kinds of different places. But now it might get a second chance because the thing that markets have lined up. And I wonder about that. Meanwhile, I'm going to be very happy to hold 2 leading auto names because there's no second chances needed. Both are in raw growth mode. Hopefully you've got some exposure or are thinking similarly. If not, and that's helpful, you know where to find me. And number 5 today, finally, I know, let's buy crypto. Boy, where to even start with this one? GameStop stock jumped again pre-market, and not because it fixed operations, found growth, or even stopped bleeding cash. Nope. GameStop rallied sharply because news broke that the company just dropped $512 million into Bitcoin. Well, you know what happened if you're looking at your screens today. The stock rose sharply, then it cratered, leaving anybody who bought in high and dry yet again in the shorts with scorch marks that would do a fireworks engineer proud. You'd think people would learn, doggone it, but then again, it just makes my head explode. When your core business is fading faster than a midnight mall traffic, buying crypto is apparently the strategy, or at least the headline. The way I see it, GameStop has now joined the MicroStrategy school of corporate hope. Slap some Bitcoin on the balance sheet and pray it papers over the fact that you're still selling pre-owned Xbox games next to clearance price hoodies. It's theater. If you want crypto exposure, and I get that you might, buy crypto, not a flailing retailer using it as a smokescreen. Speaking of which, I took a quick glance at my screens before I filmed this, and I see that Bitcoin is down a skosh today, and that the so-called whales continue to buy despite prices remaining near all-time high. Now, my experience is that's a warning sign that the game is afoot, because what it tells you is that large volume traders can easily shape low time frame performance, a fancy way of saying they will manipulate the beans out of price. Why? Because they want to separate all the scared money from theirs and move it into their own pocket. So what might their goal be? I think, or my guess anyway, is low $91,000, $92,000 per coin range, which is not coincidentally just below the $94,000 mark in the 21-week moving average that many technical analysts assign as a probable resistance point or support point for Bitcoin. So the trade idea here, if you're going to do it, Bitcoin putskis or lowball orders in the $90,000 per coin range. Today's bottom line, I think applies nicely. People are so busy trying to predict the unpredictable that they forget to think about the profitable, even often if it's smack in front of them. As always, let's make it a great day. You got this, I promise. Thanks for joining me and spending a few minutes of your valuable time with me this morning. All the best. See you tomorrow.